Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
All right, welcome everybody to Cup of Joe for April 2024. I'm filling in for Mike Carrazzo today, who's on a family vacation, much needed vacation. So, hey Mike, hope you're listening wherever you are out there. And Nick, good to be with you today.
Hey, you as well, Jason. I'm actually tuning in from our Salt Lake City office. So I'm actually looking out through these windows at some pretty swanky mountains.
I'm jealous of the view. Yeah, it's been a minute since I've done this with you, so hopefully I'm not too rusty, but we got a lot to talk about today.
We've got a little bit to talk about. I don't know if I should be wearing red, white, and blue today, or all black, or all red. We got we got a lot going on in the markets today, and a lot of things we kind of need to unpack too, because I would say we were caught off guard. I would say most of the world was probably caught off guard by what we learned in the last few days.
Right, a lot has happened in just the last 24 hours. We're trying to stay on top of this as much as we can. We know there's a lot of questions and uncertainty, and that's why we're here. So we've got a lot to cover, and hopefully we'll have some good questions from the audience today.
Absolutely. Let me go ahead and pull things up just to make sure, Jason, you're able to see what I got going, right? Awesome. Because I was having a little bit of Zoom issue. Hopefully our viewers aren't having any issues on their end. But let's go ahead and hop right into it. We may be having a special guest here in a little bit, assuming he's able to work through the technical issues. But before we get into anything, as always, we got to cover the safe harbor provision. These are the opinions of Nick Webb and Jason Pounders. These are not the opinions of Ryerson. We are not legal experts, nor do we pretend to be. We have a lot to discuss with regards to trade and legal related matters. We'll give you as much information as we can, but by no means take this as financial advice or trading advice or legal advice. First things first, looking at the ISM PMIs, so the Institute of Supply Management. Again, this is survey data. Any one of these line items that's above 50 is going to be suggestive of year-over-year growth. Anything below 50 is year-over-year weakness. And if you look up in the top left corner, the headline number that came in the last few days at 49. So it is suggestive of a little bit of year-over-year weakness. That's on the back of 2 straight months of positive territory. So it does kind of feel like maybe we saw a little bit of pre-buying from some domestic buyers, and maybe they've gone to the sidelines for a period of time while commodity prices have gone substantially higher. It does look as though that may be the case. And when you go down a few lines, you look at the prices section, and we'll revisit this a few times here in today's podcast. The prices element has soared higher up to 69.4. That's going to be evident in many of the commodities we're going to be discussing, whether it's steel, whether it's aluminum, plate products. Seen quite a bit of big moves higher in those commodities over the last couple months, which we'll be diving into in a little bit deeper. Switching over to the S&P Global indices, which gives us a better look into where global PMIs are. And again, if we go left to right, it's going to be April 2024 through the most recent data, March of 25. Left-hand column is going to show you all the regions of the world. And a couple things to point out. The S&P Global PMIs have come in a little more optimistic for the U.S., coming in at 50.2, so it's very slightly in positive territory. Unfortunately for our friends on the north and south, Canada, Mexico are seeing a little bit of weakness. And I would say probably no surprise. We've been seeing this for the last 2 months now, where I think a lot of these tariff-related matters are creating a little bit of bite for our neighbors. Just a lot of uncertainty, a lot of questions around, who can we buy from? If we do buy from some of our neighbors, what's that tariff rate going to look like? So I think those questions have created some stoppages and maybe tapering offs in some buy patterns. When we look around the world, China has actually shown some decent optimism at 51.2. I think that's probably an overlooked item at the moment. You look at the headline number of the global figure has moved, is continuing to move into positive territory. And even as we go over the pond and we look at the European region, while still in negative territory, the European PMIs are moving a little bit higher into what I would call is less pessimistic territory, so less recessionary territory. Europe over the last couple of months has done a few efforts to kind of do whatever it takes to try and prop up their economy and really get their industrial complex moving. It looks like that's, we're kind of seeing the early stages of some of those factors. Moving quickly over to services, I've just got a couple more slides before we get into the crux of the conversation today, which is going to be tariffs. This is the ISM Services Index. Again, looks very, very similar to the manufacturing data points, but still sitting in positive territory for services. It's not in vastly positive territory at 50.8, but again, we have this common theme of prices still sitting in very elevated territory. We've got prices at 60.9. So both on the services as well as the manufacturing side, prices are remaining a bit of a pesky issue. Now, it's a bit of on the opposite side of things is the employment side of the surveys, where employment data in both surveys is on the weakening side. Now, that being said, so that's all survey data, whether we're looking at ISM, whether we're looking at S&P PMIs, those are all just how are you feeling about the economy. I think oftentimes, and particularly now, we're seeing very large divergences between how industry participants are viewing the current administration. I think for anybody who's on maybe the conservative side, maybe anybody who voted for this current administration, they're actually viewing inflation to be somewhat intact. They're viewing consumer conditions to be pretty solid. Whereas if you go over to the Democratic side of things, it's kind of the opposite. They're expecting inflation to take off and really run higher. And the consumer sentiment is extremely weak, weakening down to levels really we didn't even see during the COVID lows. So the reason why I bring that up is I oftentimes like to contrast some of the survey data with more hard data, actual sales data, actual purchasing data. And that's what we're looking at here. So this is going to be the U.S. durable goods orders. So these are actual orders year over year. They're not going gangbusters, but they're certainly stable in slightly positive territory at 0.5%. And then flipping over to the right chart, which is U.S. industrial production, similar story, not going gangbusters, but in positive territory at plus 1.4% year over year. So, I think some of this hard data helps to cut through some of the noise of the surveys, where that's more of a gut feel, an opinion, very bipolar feelings about the current administration, which maybe rightfully so. But I think the hard data helps to allow us to take a step back and see things as somewhat stable, at least for now. And why I say at least for now, we've gotten some pretty big news in the last few days with regards to reciprocal tariffs and the impact that could have on market conditions. So, Jason, has Jeff by chance joined? I haven't had a chance to look.
Yeah, he's on. Yeah, Jeff.
Oh, excellent. Yeah. Our guest star has made it. So this is really going to be the meat of the podcast. And so I've got a couple slides that I'll introduce things on, kind of tee up how we got to where we are. And then hopefully Jeff and I can just have sort of an open conversation. And, as questions roll in, we certainly want to take them. So with that, let's go ahead and hop in real quick. So why are we in the situation of having tariffs and protectionism even in the first place? Some of these things shouldn't be too much of a surprise, but I think the visuals help oftentimes. This is a chart going back to the early 1990s, and this is looking at the U.S. trade balance. So that is just looking at how much do we export relative to how much do we import. And as you can see over on the right-hand axis, really for the last 30 years, we've been in negative territory, which means that we as a country import significantly more in terms of goods than we do export. And unfortunately, that trend has grown pretty drastically. I say unfortunately, I'm putting my opinion in here a little bit. But, some of this is due to globalization. Some of this is due to the fact that China has sort of burst on the scene since the late 90s and 2000s and, started to take a much larger share of global trade. But nonetheless, this is a trend that the administration is certainly looking at. And I would say if we ignore the most recent data points, which in my opinion were probably U.S. companies pre-buying, trying to get in front of the tariffs, taking the trade deficit extremely low, I would say that we're currently trending somewhere around negative $80 billion. And this trend doesn't really appear to be showing any signs of slowing down. So this is certainly one aspect of what the president wants to address. Another aspect that I think the administration wants to address is this one, which is manufacturing jobs in the United States. If we go back to 1990, about 18 million jobs in the United States were manufacturing related. And if you look at that as a percentage of the population of the United States back in 1990, it was about 7.4% of the population was in manufacturing jobs. Fast forward to where we are right now, it's about half that. It's all the way down at 3.7%, or 12.7 million jobs is where we're currently sitting right now. And again, it's a similar phenomenon to the last slide. It's just, as we're sending more goods manufacturing overseas, whether it's for cheaper labor or, better access to raw ingredients, whatever the case, this phenomenon is correlated with both jobs and with trade deficits. So this too is something that I think the administration wants to have a look at. And then last but not least, I was actually, as I was on my flight out here to Utah, I was having a conversation with one of my old colleagues, very intelligent individual, somewhat of an economist buff. And he was bringing up the notion that back in General Motors' heyday, so I think this is a fairly interesting thought experiment. So on the left-hand side, you've got General Motors. They really kind of peaked out from a growth standpoint somewhere in the late 1970s, early 1980s. And if we look at 1979, General Motors employed 618,000 people, and at least according to Grok, an artificial intelligence model, their market cap at the time was somewhere around $15 billion. So $15 billion, they employed 618,000 people. If we inflation adjust that $15 billion up to current modern day market caps, that puts General Motors peak market cap in modern day time somewhere around $65 billion. So $65 billion with 618,000 people. If you assume, and I don't know if these are the exact right metrics, but if we say, market cap per employee, basically what is the market value if you divide it among each one of those employees who works for General Motors, it's right around $100,000. If you compare that to what the average salary of a General Motors employee was and adjusted it for inflation, that average salary is about $95,000. So pretty comparable in terms of the labor or salary rates relative to that market cap per employee figure. So this is somewhere, this is a point in time where we had, a very large emphasis on labor. You had a very strong middle class. I would say the wealth divide wasn't all that massive, certainly not where it would be today. And I would say the country was living in a much more modest fashion. Your highs and your lows tended to be a little more tight to one another. Fast forward to where we are right now, the leader within the economy is, one of them is going to be Meta, which is Facebook. So as a comparable, Facebook has 74,000 employees right now, a current market cap of $1.5 trillion. So less employees, but a market cap that is, I don't know what, about 20 times what the inflation adjusted market cap was for GM. That puts it at a market cap per employee of about $20 million. That compares to 100,000 for GM's peak. So we had this phenomenon where we as a country have basically gone from a labor-based economy to one that's really kind of deemed to be a capital-based economy, where if you're trying to extract value from what Meta is, you really would do so via investing in their stock. You would extract that value by, taking a position in them 10, 15 years ago. You would be very, very wealthy at the moment. But that would be on the back of, extreme increases in their valuation from how they're deploying capital. Their cost of capital is much lower. Their cost of assets is much lower. For all intents and purposes, they are certainly a much more efficient company. But what they don't have is as much of a focus on labor, capital expenditures, which I would argue General Motors certainly would have had. So we have definitely gone from more of a labor-based economy to a capital-based economy. And I think the current administration really wants to kind of bring these things back into a tighter range, because what we currently have right now is a situation where the U.S. is, I'm talking extremes a little bit, but you kind of have a situation where cities and coasts, extremely wealthy, a lot of that by way of equity market cap, whereby you kind of have a hollowed out middle class where manufacturing jobs have left the country, and your wealth divide has grown pretty massively. So I'm not going to say that all things with regards to tariffs or all things with regards to this current administration are good or beneficial. But I think this is the context under which the administration is currently operating, that they're trying to bring in just a better balance with regards to the middle class relative to the upper class. And in this case, I'm calling kind of the upper class, the tech executives and those who have invested in those tech companies. Now, before I dish it over to Jeff and open it up for conversation, this is really the summary of what we've seen in the last couple of days. The left-hand chart is showing average tariff rates for the United States going all the way back to 1820. And you go over to the right-hand side, you see the little gold diamond and the red diamond. Those are the average tariff rates for where the United States was as of last month, and then where we are as of today, now that we have this Liberation Day reciprocal tariffs. And it may not look like a real big jump, but this is the highest level of average tariffs going all the way back to the 1930s when we had Smoot-Hawley go into effect. Now, I know there are very differing opinions on whether or not Smoot-Hawley was a good thing, bad thing, but nonetheless, that is where we are currently sitting. So that gives you some historical context on how sizable these moves have been in the last few days. And over on the right-hand side, that chart is showing the average tariff rate by country, by trading partners. And you can see the biggest jumps are ultimately going to be on China, Vietnam, Indonesia. I'm going to dive into one of these in a little more detail here in just a sec before I dish it over to Jeff. But these, I would say, whether we like it or not, these tariff rates, these tariff increases on the reciprocal side caught most analysts and traders off guard. I would say the highest expectation was that we were going to see somewhere around 20-25% tariffs on an average basis, when in reality, on a trade-weighted basis, we're seeing that well above 20%, and in some cases significantly larger for some of the bigger trading partners. Now, this was an official sort of card or template that was used by Trump when he was actually presenting the reciprocal tariffs to about 150 people in the Rose Garden. And I know it's a little blurry. I apologize. I had to zoom in quite a bit to get these figures. But I wanted to highlight a couple things. One is this first column is basically showing the U.S.'s interpretation or estimate of what the administration is viewing as the tariffs or protectionist measures that are being put on the United States from other countries. That is an approximation looking at both trade and non-trade related barriers, as well as any currency manipulation that they deem to be in effect. Now, a lot of those might sound like opinions, and I would say they kind of are in some ways. You know, whether a country is a currency manipulator versus not, kind of an opinion. But ultimately, the administration was using those rates, cutting them in half roughly, and then saying that that's the rate that we're going to apply to everyone else in this reciprocation. So, you know, Trump was pretty proud in saying that the tariffs that they're announcing they're very small. They're only half of what other countries have on us. Well, in reality, those rates that are shown in this middle column here, those are not in fact tariffs that are being placed directly on the United States. So let's take Vietnam, for example. That 90% rate, Vietnam, in fact, does not have a 90% tariff rate on the United States. What Vietnam has is a trade surplus with the United States of 90%. And to put numbers around that, Vietnam ships to the United States about 123 billion, $124 billion worth of goods that they ship to the United States, whereas the United States only ships about $14 billion worth of goods to Vietnam. They are purely viewing that as a 90% tariff rate, which there are a lot of skeptics saying that is not the appropriate way to view what the reciprocation should be built upon. But alas, that's where we are today. And the market is basically, I guess, the new reciprocal tariffs are being set at half that. So the punishment on any Vietnamese goods coming into the country is presently being set at 46%. Now, in reality, if we actually look at where Vietnamese tariffs are on the United States in the last month or so, and over the course of 2024, I think the rate was somewhere around 9%, 9.0, not 90%. So the market's kind of shocked by how the U.S. is approaching this. And I'm not here to say whether that's right or wrong. I'm just saying that seems to be the market's interpretation. And I think when you look out to the stock market, you look out to the way other countries and economists are reacting, it's a pretty big knee-jerk reaction and a pretty big shock based on those values. So I hope I did an okay job explaining that, but happy to come back and do it. But with that said, I'm going to kind of open it up and get the discussion going with Jeff. So I'll stop my screen sharing. And
hey, Nick, I got a question already.
Yeah.
I don't know if we know I know there's been some gray around this too. The reciprocal tariffs, is that on top of the base that was already previously set? So is that a 44% or is that 24 plus 34? How does that, do we know where we got that?
Yeah, so we kind of got to be careful on how I answer this because it sort of depends. And okay. Hopefully Jeff can back me up on this. But as an example, in the last 30, 45 days, the United States has put 2 sets of 10% tariffs on all Chinese goods. And that would have been under the IEPA, which is the fentanyl and border control related tariffs. So that summed up to be 20% just in the last 30, 45 days.
Okay.
China in the last 2 days now, I guess with these reciprocal tariffs, that was a 35% reciprocal tariff. That is being viewed as in addition to the 20%. So where we sit right now, that is a 54% tariff on all Chinese goods. Okay. We can go into as much detail as we need, but as we understand it, anything related to Section 232, which would be steel and aluminum tariffs, that, as we understand it, sits in a totally separate regime and is not additive to these reciprocal tariffs or the IEPA. But in terms of the IEPA and the reciprocal, those, from what we can tell, do some. So we're talking about, in some cases, some pretty big figures from a percentage basis, and also some pretty big figures from a dollar standpoint for some nations as well.
Sure.
Yeah,
okay.
Nick, it was interesting because the new tariffs, these reciprocal, were also applied using that IEEPA methodology as well, the emergency powers.
That's right. Yeah, and I think already, we can go down a lot of different rabbit holes here, but I think already there are some debates on whether or not what the administration did with regards to the reciprocal tariffs is even constitutional. Because I was under the impression personally, and I'll throw myself on the sword and say I was wrong thus far. I was under the impression that reciprocal tariffs is going to be, if Europe has a 3% tariff on the United States, the U.S. is going to put a 3% tariff on all European goods. That doesn't appear what they're doing. It appears as though what they're saying is, if we have a trade imbalance with the EU of $100 billion, and that $100 billion equates to 30% of a trade deficit, then your tariff is going to be 30% times 0.5. We're going to charge you a tariff of 15%. So it's a different read on how they're viewing this reciprocation definition, and I think there's going to be a lot more detail to come out about this in the coming days and weeks.
Yeah, I definitely was under the same impression as you. I mean, I think there was an example of a Harley Davidson motorcycle and having a tariff on it going into someplace in Europe or even Vietnam. And the idea was, okay, if Vietnam builds a motorcycle and it comes into the US, it's going to be hit with exactly the same tariff. And that thus being a reciprocal tariff for like goods. But the calculation is it's a little hard to get your head around at this point, but it's a starting point.
Yeah, and it's really tricky because, at least as it stands right now, as it's written right now, and let's come back to that Vietnamese example. So let's say Vietnam, and let's say they only produce one thing. Let's say they only produce textiles. Vietnam sends to the United States $123 billion worth of textiles. And Nike, Adidas, everyone's buying the product. And let's say currently they're not paying a tariff on that product. In this case, so the tariff rate effectively goes today, or I guess in the next few days. It'll kick in on April 9th.
Well, the April 5th is the. Sorry, I'm just looking at my cheat sheet here. The IEPA is April 5th, and then April 9th is that's the 10% is the April 5th. And then if they're named more than 10% is April 9th, the higher rate. Yeah.
So on April 9th, if you're Adidas, you're Nike, and you were bringing in billions of dollars worth of textiles from Vietnam has now got a 45% reciprocal tariff on it, which means that $123 billion worth of goods, unless we find a better supply chain in the next 5 days, that product's going to still come in and it's just going to get hit with a 45% tariff. The hurdle I see is there's not really a whole lot Vietnam, at least as I'm thinking out loud, and I'd love to hear your thoughts, Jeff. There's not a whole lot Vietnam can do, even if they said, hey, Trump, we'll take our tariffs to 0%, from 9% all the way to 0%. The way the current calculations on reciprocation is being done on the trade imbalance, not on the tariff rate itself. So if Vietnam took its tariff rate to 0% on U.S. goods, they're still going to say, well, Nike and Adidas are still buying the textiles from your country. We still have a trade imbalance. Thus, we still need to have a tariff in place. And the reason why I think that's a concern or a hurdle is just that $123 billion, the only way Vietnam, under the current rules, can counteract that is by buying $123 billion worth of U.S. product to balance out the trade deficit. And it's basically a fourth of Vietnam's GDP. And I'm not aware of any U.S. goods that Vietnam's in massive, massive need of in the immediate term. So under the current structure, these reciprocal tariffs are looking pretty burdensome. And I don't think it's any secret when you go out to the stock market and you look at shares of Nike right now. I haven't looked in the last 20 minutes, but I think they're down 15% today in one day, probably the biggest move they've had in, I guess, decades. Restoration Hardware, who's a big importer of foreign raw materials for making furniture, I think they're down 45% today. And all of this is a function of there's going to be a tariff that's going to get quickly and massively brought into these supply chains. Yeah. The good news is sorry, go ahead.
Oh no, I was just going to say, I think you bring up a really good point, because if it is a true imbalance, the only way you can rectify that is by either buying more from the U.S. or selling them less. And we talk a lot about the imbalance with Canada, with energy and with the crude oil. We have the crude oil and then we have the aluminum, and they're somewhere between 53 and 60% of the U.S.'s consumption. So you say, okay, if we were to go to a net zero, Canada would just stop selling the U.S. roughly half of their aluminum and half of their oil, on which they are buying at that market competitive prices. So you have to wonder what the end game is on something like that.
Yeah, I mean, I know there have been some trade deals where, like, as I understand it, China at one point said, we'll buy a bunch of grains and we'll buy a bunch of livestock from the United States, and they signed these big deals and it was celebrated, and then those agricultural deals never came to fruition. So they ended up sort of falling on deaf ears. So maybe we've been burned too many times with sort of these "I'll promise you I'll do this" type deals. But at the same time, it's hard to see, at least under the current structure, where the negotiations are ultimately going to find a resolution in the short term. And
I was doing a little digging into the automotive, because that's a hot topic right now, given all of the tariffs back and forth, in Canada announcing reciprocal 25% on US made autos. But I wasn't aware there's 325 to 328 models that are sold in North America. America produces 121 of them, and Canada produces 14. So when you start breaking down the numbers, there's a lot of noise around stuff. And again, I refer to this as a starting point, which I truly believe the negotiation, you throw out something absolutely wild and then you bring it back. I'm a firm believer that deals will be made. Things will come down from these numbers. This is the initial shock and awe, and cooler heads will sort of prevail over a period of time.
I tend to agree with you, although I will say I was taken aback quite a bit when I saw how these were structured and just the ultimate size of them. But I still tend to agree with you. I don't think the ultimate goal is pure chaos. Maybe just partial chaos.
We'll see.
Yeah. Jason, before we hop into anything else, should we take any questions? You got anything for us?
Sure, we got a few coming in here.
Yeah.
All right. So assuming tariffs do what they're supposed to do, any estimates on what portion of manufacturing jobs could be brought back? I know this is kind of hard to probably quantify given the complexity of building new facilities and bringing jobs back, but any ideas?
I'll just give a quick high level sort of political answer, I guess. Just thinking out loud. I mean, I think it depends on the industry, depends on the product, how quickly any type of supply chain can be rerouted. If we're talking about Vietnam making a t-shirt that the United States may have an open vacant facility that we could turn on, I guarantee you Nike and Adidas are looking to see what excess capacity we have in other countries that might have better tariff rates. And the goal is to have that in the United States, obviously, but it could even wind up somewhere else. There could be a little bit of tariff gamesmanship where it goes from Vietnam to some other country that has a lower tariff rate. But assuming it comes back to the United States, maybe there's some excess capacity where, retailers can find excess, manufacturing equipment and things like that, where they could get that ramped up maybe in the coming months. You move to something a little bit more complex, like automotive, for example. You think about if you're telling Ford to take some manufacturing facility out of another country and into the United States, just as a high level example, that likely is going to require somewhere around $3 to $5 billion, maybe more, to build a new factory, to get all the employees, get all the land rights and all that. It's also going to take maybe 3 to 5 years in order to get that planning process put in place. And I mean, I'm no betting man, but I would say if the market continues to act the way it is today and the way it has been the last few weeks, I would guess that the current administration is going to lose its luster a little bit, even with some conservatives, because a lot of us do have money in markets, and a lot of people don't. Most people I know don't like losing this kind of money this quickly. There's a chance that by the time you would get an automotive plant built and all the employees put in place, we can have a new administration, and it may not be JD Vance. It may not be it's probably not going to be President Trump, and it may not be JD Vance. And if it's not, we could have a regime that turns these tariffs on their head again, in which case you start wondering, does it even make sense to make that investment? That was kind of a long-winded answer of saying it's going to vary industry by industry, but some of them get really expensive and really, really time sensitive.
Yeah. Okay. Yeah. And a lot of these aren't shuttered. They've been gone for a long time, right? So it's new construction. It's starting from scratch.
For sure.
Okay. So steel and aluminum is 25% tariff from anywhere. Is that correct?
As it stands right now, steel and aluminum under Section 232 is 25%, no exclusions, no exemptions.
Okay.
That's before any anti-dumping or circumvention duties that are also out there on different countries.
There's always a catch.
Which only means they go up.
Let's see. Okay. Let's see. Is there a tariff on goods from Mexico excluding steel and aluminum and auto parts? For example, an assembly manufacturing in Mexico out of metal. I'm not sure.
Jeff, you want to take that one first?
Well, my understanding currently that would fall under the IEEPA. And if it's a USMCA compliant good, I don't believe that there is a tariff on that. But if you're talking about shipping over a coil of aluminum or a coil of steel, that would be subject to 232.
Okay.
Yeah, and I'll just say kind of narrator note. It does feel as though there's an attempt to continue to honor USMCA. In all of the noise, it does feel as though anything USMCA is quietly getting carved out and honored. And I think the reason for that, Trump obviously put in place USMCA in his first term, and I think the end goal is going to be anything USMCA related is going to be excluded from these things, but there's a lot of noise around it.
Is this on top of Section 301?
301 really only applies to China right now. So I would say, yes, this would be stacked on top of that.
Okay. So do we think the steel and aluminum markets have already absorbed the tariffs?
So I will say just in the last 24 hours, which, one day does not make a trend, but interestingly enough, I mean, while we've got crude oil moving down 7% today, I think copper prices were down 5%. Interestingly enough, steel and aluminum prices were pretty mundane. I think we had a little bit of move lower. Aluminum maybe was down 1.5%, 2%. Steel futures were actually pretty flat today. And I think that's just because Section 232 is its own thing. So that really isn't being altered too much from the reciprocal tariffs themselves. Now, where steel and aluminum could be impacted is if these reciprocal tariffs cause people to move to the sidelines, change buying habits. We see supply chains begin to shift around. You could see some dampening effects, both dampening and or inflationary effects to both steel and aluminum. But in the short term, those two markets are actually probably the calmest. They're about the calmest of any of them today, versus what else is going on in like equity markets and other commodities.
Okay. I guess, Nick, there was just some, can you maybe try to explain again how those trade deficits translated into the tariff rate, that the chart you went over earlier?
Yeah. So, and again, using actual numbers, I did actually attempt to go out and get real live numbers. So roughly speaking, and using the Vietnamese numbers. So Vietnam, the tariff that they said that Trump said Vietnam has against the United States, they referenced 90%. Trump saying that he was being a very kind person and saying, "Oh, we won't do 90%. We'll just do 45%." So that's how he just took the 90 and went to half. So how do we get to the 90%? The 90% calculation, as I understand it, is Vietnam ships to the United States $123 billion worth of goods, and all we ship to them is about $13 billion worth of goods. It's somewhere in that realm. And so what that means is we have a 90%, on a percentage basis, we have a 90% trade deficit with Vietnam. And they are using that trade deficit, translating it into a percentage and saying that's the tariff that they have on us, which in my opinion, that is not how I understand a tariff to work. That's more of a trade imbalance, which I view it as a slightly different thing. The current administration is not viewing that as a different thing.
Okay. Thank you.
Of course.
Okay, let's see. We got a bunch. So we've seen aluminum prices from distributors go up approximately 40%. Is there a reason why this would be so much higher than the 25% tariff?
Well, so on aluminum specifically, we've seen a couple things unfold. I would say Midwest premiums, which is going to be heavily reflective of what's happened within the tariffs, pretty directly. We've seen Midwest premiums move from about 20 cents to right around 40 cents. And we can, if we get time, we'll hop into the aluminum slides later. So that's call it 20 cents of the move. And then we've also seen, as supply chains have rerouted back to the United States, we have seen lead times push out a little bit. Some of the domestic mills have taken conversion prices higher. Now, I don't know if that summation of the conversion increase plus the Midwest premium increase, I don't know if that fully equates to 40%, but it certainly gets you close to about 40 cents per pound.
Yeah, I'd agree with that, Nick. I mean, we saw movement not only on the metal component, but on the conversion, which is what we refer to as, the price that we pay to convert the metal. So suppliers, they see a price going up in the market, they're taking full advantage to charge us a higher price, whether it be domestic or import. And then we're paying that higher price on a higher base metal coming in.
Nick, I think, correct me if I'm wrong. So stainless has kind of remained pretty flat, right?
Stainless of the bunch has been the most subdued. And I would say that's primarily because it's already been, for the most part, at least, ignoring the West Coast, is mostly a domestic market. We've got two big players. They've got capacity that's available to ramp up if needed. And yeah, so we've seen small increases in the base price for stainless. very small increases in the price of nickel, but on a relative basis to carbon prices, plate prices, and or aluminum prices, much more mundane.
Okay.
And even copper prices. I know that maybe we're not on that topic, but we'll get to it eventually.
That's December.
Exactly.
Jeff, here's one, I guess, for you too. What tariffs are reciprocal in Canada for steel and aluminum? What are you guys seeing up there? Coming out of the U.S.
Currently, it's under 232. It's 25% coming into Canada if it's a U.S. origin good, and it's 25% on the good going back into the U.S. Now, there are some rumblings of government drawbacks on the Canadian side if the good is going to be re-exported to the United States after it's manufactured. There may be some kind of relief there to go after that. But a lot of these things are, there's a lot of election campaigns on the ground right now in Canada. We have an election coming up at the end of this month, and tariffs are a big part of that. So there's promises being made. Nick and I were talking just before the call where Carney was at a customer in a manufacturer in Winnipeg the other day and said, I'll make sure that you're exempted from this. Well, I can't do anything with that when the goods cross the border until that's actually put in writing and it's applied to an HTS code. But it's I'll chalk it up to campaign promises at this point.
Some things are the same on both sides of the border, right?
There are a lot of things that are the same on both sides of the border.
Yeah, exactly. Okay, so I guess for Mexico, so fabricated parts made out of steel in Mexico, would they be charged a 25% tariff under USMCA?
Again, there's a complex calculation for goods that fall under USMCA. It takes into account how much you paid for the goods, how much labor you put in. My understanding on that is if you satisfy the USMCA requirement, those goods are not currently being charged.
Okay.
That's what I understand as well.
They're coming in fast.
I was just going to say that number seems to be going up, not down.
Yeah, exactly. Let's see. I'm trying to keep my place here. So if you're importing aluminum, importing an aluminum part from China, what would the calculated tariff actually equate to?
Boy, aluminum is a heck of a one to bring that in, because if you just brought aluminum, there's over 100% anti-dumping and circumvention tariffs before we even get into the 20% Nick talked about, or this reciprocal tariff that
34%
can be applied. So right now, I hate to give a non-specific answer, but you have to look up the HTS code. You have to see what rate is valued on that good, and you have to apply all of these rates together to come up with that. So I know it's a vague answer, but there is no one size fits all when it comes to tariffs. It's on a case by case basis, item by item basis.
Okay, this is a good one. Are all the costs involved with production, transportation, all of those, when you add all that up, is that where the total the tariff is applied to? The total cost of the goods?
Yeah, the total, the easiest way to look at this is what is the value of the good when it leaves the person who's made it. Okay, so we referred in the last Cup of Joe to the FOB stowed value, the FOB, freight on board value of the good when it leaves. So if you made a part and you said it was $3 and you declared that on the customs invoice, it's $3, it crosses the border at 25%, it's going to be $3.75 when it gets there. The only thing that you do not pay the tariff on is the freight to get it from whoever made it to whoever's buying it.
Okay.
I didn't know we were talking Incoterms today.
I love Incoterms. It always comes back to it.
Can you comment at all on the Venezuela oil tariff and impacts, and have there been any details released?
No details released, but the possibility that's being floated around is additional tariffs on any country that procures energy and energy products from Venezuela. The largest of which I believe is China. So among other nations, the expectation is those would be stackable. So that's kind of one of those things that if the administration gets upset with Venezuela for whatever reason, and or they get upset with whoever ultimately buys energy products from Venezuela, that's just another way to pile on more tariffs, more punishment.
And
but no, nothing's gone into effect yet, I don't believe.
No, but I think they're currently throwing around a rate of 50% additional just for that piece alone.
Okay. Have we heard any talk about, any countries blocking U.S. out of trade? Like trade embargoes?
I haven't heard trade embargoes, although I guess I'll lean on Penz because it sounds like some of our neighbors up north are already taking the bourbon off the shelves.
They took that off after putting it all back on after the first wave of tariffs were talked about and then delayed. But probably the thing that I've heard most recently is China, Japan, and Korea are apparently in talks to figure out how to respond to the U.S. tariff. So it's kind of funny because anyone who knows that part of the world, there's not a lot of love lost amongst those three countries with each other. But now it's kind of bringing them together to say, hey, how do we respond?
Yeah, this is kind of a quick and dirty, but I took a screenshot of this earlier this morning just so I had it handy. Just running through a quick list. The European Union, just as like a soundbite, they said they are going to do prepared retaliatory measures on top of what we just did. China said they are going to potentially take countermeasures. So you can see the rhetoric here. Germany calls on the EU to pressure President Trump. So that's a bit more of I'd say retaliatory type language. Japan, their language is saying these counter or these reciprocal tariffs are regrettable and they're hoping to get exemptions. So you can see Japan taking a slightly different tune where they're kind of saying, maybe we can get in the negotiating room and have a softer approach than say the EU, Germany, and China. I guess the EU is Germany. And then Canada thus far has said that they are going to do countermeasures. And then even Mexico is saying they're going to do countermeasures. I don't know if Jeff Penz, you have any thoughts on this, but I still I like to believe that Canada and Mexico are still going to ultimately warm up and we're going to be maybe not one big happy family, but a happier family than where we are.
I would really like to believe that. I mean, I'm hoping that happens. And, when you get into these type of situations, it's always people want to appear that they won in this negotiation. And, you and I have talked a little bit back and forth on how we think that might play out. And really, the option that exists right now is an announcement with the leaders coming together, much like when USMCA was negotiated last time. The leaders of each country got together and there was a press conference and there was a signing ceremony and everyone said, we have come together to agree on this path going forward. And honestly, I don't see anyone dropping their tariffs or counter tariffs until we reach that point and they all can say, we did this together. And I'm hoping that, that is the case and that's how it does play out.
Yeah, Jeff, it was actually really interesting yesterday morning. And I've got a video of it, but I would encourage everybody to go out and find this. It was, April 2nd in the morning. And it was Doug Ford, who is the Ontario Premier, basically kind of like the head of the province, right? He was on CNBC with Andrew Ross Sorkin and Joe Kiernan on Squawk Box on CNBC. And they were having a debate about whether or not these tariffs should go into place or not. And the Ontario Premier basically said, look, Canada's not the enemy. We are not the actual enemy. China is the real enemy. That's where we should be placing all of our focus. And so Andrew Ross Sorkin, and I don't want to talk too much politics, but Andrew Ross Sorkin, I would say generally leans fairly left. I think Doug Ford generally leans somewhat left. But even Andrew Ross Sorkin was kind of like, hey, you've got tariffs on the United States. Why don't you take them to zero, and then there won't be any ability to retaliate. There will be nothing to retaliate against. There'll just be no tariffs. And he's like, yeah, we've thrown that out to the administration, but nothing to do yet. And you could kind of see Andrew Ross Sorkin getting a little frustrated in the conversation. He's like, just take them to zero, and then there'll be zero on both sides. And I do think Jeff Penz is right, where just optically, politically, I think both sides kind of want to be able to point to something and say, I won, I did that. Look what we did. We just had an agreement, and this is how we won. But along the way, you get these crazy tariffs put in place. You get markets roiled for a couple of days, maybe a couple of weeks, and then they both get to claim victory. And I think there's a bit of that going on, unfortunately.
Yeah. Everybody has to win.
Everybody's got to win.
So, Nick, you and I kind of talked a little bit about this before that we started live. No mention of really Canada and Mexico yesterday on the president's announcement. You want to speak to that a little bit?
Yeah, no explicit mention, and they weren't even listed within like the larger like card of all of the individual nations, but they within the reciprocal tariffs, they did say there's going to be a blanket 10% across the board on everybody. Now, and to our expectation, that includes Canada and Mexico within that blanket. Is that something that's negotiable? Probably. I would say hopefully most particularly for Canada and Mexico. But yeah, they were not explicitly referenced. Nor was the fact that one day before the reciprocal tariffs were put in place, Vietnam actually did drop their tariff rates on a number of goods. They didn't take them to zero, but they did drop their tariff rates on things like, I want to say it was like chicken thighs and some automotive products. But that wasn't mentioned in the Rose Garden, because I think that'll be something that comes later as, look, I won, I got them to drop their tariffs, but we'll have to wait and see.
There was one mention of it in the document, Nick, and I think it's quite deep in it. And right? The only thing I'm just going to take the other side of the coin on that and say I do believe they were exempted from the 10% because it mentions, again, this is under the IEEPA Act.
Okay.
And that's the border security and fentanyl issue.
Okay.
What the way I read it was the 10% doesn't apply to US or Canada and Mexico because we're already dealing with them on the border security and fentanyl under the IEEPA. And that may be resolved or pushed down the road further. So that's how I'm reading it. But with any of these government documents, there's open to interpretation when you look at it. So.
And to remind everyone, if it does fall under IEEPA, if it is USMCA compliant, that effectively takes it to zero. So,
right,
while it's 10%, it may actually be something much less.
Correct. And I know there was some statistic thrown out earlier in the week that 90+% of the trade between Canada and US is tariff free.
Yeah.
So that's kind of something we have to kind of keep going back to when people hear 25% on this, and then you say, oh, the sky is falling, and you say, well, but most of our trade is tariff free. At this point, you have to kind of wonder. I know steel and aluminum's 25. That's getting hit, but the other stuff is mostly USMCA compliant.
Good point. Nick, any idea where steel prices are going to go from here? Your crystal ball.
With that, I think visuals are always helpful. I'm gonna pull back up my.
All right, go to the handy slides. Yeah,
let's do it. And we're happy to take any of these questions at any point in time. I may jump around for a minute or two at some point, but so as we look at steel prices, this is looking at U.S. hot roll prices in white, Northern Europe prices in blue, and Chinese prices in orange. And China, not much new to report. Their prices are still in the doldrums, but as Jeff can attest, the tariffs on Chinese steel are so high that nobody over here is buying that product. But what is interesting, in the last couple of months, we have seen some upside moves in European prices. We talked about the fact that European PMIs are kind of coming out of recessionary conditions. It looks like they're trying to revitalize their industrial base a little bit, particularly in Germany and France. And that is starting to put a little bit of a floor under under European prices as well, which all things being equal, I would say that probably lifts the floor a little bit for how low, if we do see U.S. steel prices peak out and start to fade a little, kind of raises the floor on how low we would ultimately go. But where I apologize, I don't have a specific chart on the futures curve, but as we look forward between now and let's say summer months, there's actually a decent backwardation or downward slope in the futures market, which is an expectation that we are somewhere near the peak. So current prices are in the 960s per CRU. The summer month hot roll prices are around, I'd say 830, 840. So there's an expectation we see that we may see lower prices in the coming months. Interestingly enough, though, the CRU just yesterday did print higher by I think something like $35. So that kind of had some people scratching their heads thinking, well, maybe this thing's not completely done. But are we going to soar above $1,000? I don't think so, unless there are further protectionist measures taking place, or massive reshoring in a very short period of time, which those things tend to take more time than just a couple days, couple weeks.
Yeah.
But that being said, while we're on the topic of steel, this is not a trade recommendation. This is not financial advice to any degree, but I just found this interesting. Because in addition to doing Cup of Joe, I do also help our customers manage price risk. And one of the things that I thought was pretty interesting was you look on the left-hand side, that's the spot price of steel over the last couple months. And since January 14th, the price of steel on a spot basis is up like 30%, which is a very meaningful move in the last 2.5 months. You look at the 6-month average hedge, so basically the average of the next 6 months of futures prices, the rolling 6-month hedge price has only moved up by about 8 or 9%. So the point of that is to say, for anybody who's saying, man, that move up in steel prices really hurt, that stank, that wasn't fun at all. The futures market is allowing customers the opportunity to lock up pricing for basically the back half of the year or like summer months through the end of the year at a pretty decent discount to where the current spot number is. What we can't say is, is that mid 800 type number, is it going to be good, bad, or indifferent? But what we can say is we know right now that it's about $120, $130 below the current spot market. So for those who feel like they kind of missed the boat and didn't get enough, pre-tariff steel, the futures market is offering some somewhat interesting pricing out there. Again, not investment advice, but kind of interesting that the market is presenting that opportunity given all the protectionism.
Great. Well, we're coming up on the hour. Still a few questions.
Well, if I could, Jason, can I throw a slight bit of spice into?
Absolutely.
Awesome.
That's what we live for, the spice.
So this is a little bit of a dark joke, but so over on the left-hand side, that's an actual image of what took place with the Rose Garden. You can see him holding the placard with all the tariff rates and how he was going to be so kind and cutting them in half, and that's going to be the applicable tariff rate on all the countries. Some people have joked that what he's really looking at is over here on the right-hand side, which is effectively a bloodbath for stock markets. I don't want to say Trump meant to do that, but there is a chance that he's crazy like a fox. I actually saw, I think it was a hedge fund manager named Bill Ackman yesterday. He said, the best way to negotiate is to make other people think you're crazy. And there might be a little bit of that going on, because there's certainly a lot of pain being felt within the asset management community and 401k world. But when you take this, this chart of what stock price has been doing the last couple months, and you compare it to the rest of the world, it's kind of interesting to say that Q1 was actually one of the worst quarters that we've seen in the last couple decades relative to the rest of the world. So the U.S. performance relative to the rest of the world underperformed by the largest since the Enron collapse, and WorldCom and Tyco. Doesn't happen very often that the U.S. underperforms like that. But what if I threw out a conspiracy theory? Get on your tinfoil hats, or your aluminum hats rather. There's a chance that some of this could be slightly purposeful. Now, why would that be purposeful? Well, Trump's been pretty vocal, and I've pulled a couple sound bites in here. You can see this Howard Lutnick quote, and then his press secretary, and Trump's pounding the table. He's almost at odds with Jerome Powell, the central bank head, in saying we need lower rates, but yet Powell is still kind of very patient and saying you can't tell me what to do. This is a chart of the 10-year Treasury yield. And you can see that since Jay Powell started cutting rates back in September, nothing's happened, but the 10-year Treasury rate has gone up. Well, I've drawn in these extra lines to signify what's in a trading world. It's called a head and shoulders pattern. You can see the shoulder, the head, and then you see the neckline here. 4.15% on the 10-year Treasury was a pretty important area of support that I think a lot of traders were watching. It wouldn't totally shock me if Trump was kind of like, you know what, we need lower rates. We've got $9 trillion in debt that has to be refinanced over the course of 2025. We don't want to do that if interest rates are high. So let's figure out ways to get them lower. And you look down here in the bottom right corner, his press secretary said Trump is focused on lowering costs while raising tariffs. Those two things kind of go in contrast to one another. Raising tariffs can be inflationary, which doesn't typically sync up with the idea of lowering costs, unless you allow for the idea of a potential recession to seep into your head. There's a chance that Trump and the administration wanted to create something that was so massive, so scary, so confusing that markets just freak out. And I would say, when we look at interest rates, thus far he's been kind of successful. If interest rates and refinancing at lower rates is the name of the game, and that's the only name of the game, then he's been pseudo successful over the last couple of weeks. Now, at what expense? It's at the expense of several $1 trillion worth of net worths across the country. So it seems to be one that he's willing to take, at least in the short term. He actually had a post earlier today where he basically said, referring to the United States and these tariffs, he basically referred to the United States as a patient who had just undergone an operation, and the surgery is now over, and now it's time to heal and make it through the recovery phase, I guess. So his verbiage seems to be one that's at least medium term in nature, that he's willing to take some pain in order to get these rates a little bit lower so that we can refinance at lower rates. But I don't know, maybe that's just conspiracy theory, Nick, but I thought that was kind of an interesting combination of things.
So Nick, if that's actually the case, and it's the refinancing at a lower interest rate, those are coming due on a somewhat regular basis, are they not? Or is it just an annual event where it's one and done for a while?
They're coming due. It's on a rolling basis. So that $9 trillion is going to be all the time. Yeah.
Right. So it's not like they could say, okay, we've refinanced everything as of today. Oh, guess what? We've settled all these reciprocal and we let the stock market bounce back up. But we just had refinanced this. They would have to maintain this pattern for a foreseeable period, if that is in fact the end.
Yeah. Right? Well, I mean, and I'm not wishing this at all. I'm just throwing out possibilities. I hate to say it, but I don't think Trump is an equity guy. I don't think he's a stock market guy. He's a real estate guy. There's a chance he doesn't own any stocks. There's a chance he doesn't care what happens to the stock market for the next 6 months, 8 months. The unfortunate thing is there could be some job losses on the back end of all this. And if job losses start to take place, I think Jay Powell would be hard pressed to not take notice of that and say, we have to be more accommodative. Mm-hmm. So is it political? Is it gamesmanship? I think it could be. I think there could be some of that going on.
Jeff, you referenced the tip sheet. Do you have something we could share with the audience after this?
I'd be happy to send it to you. I've been kind of keeping tabs on announcements and writing them in as far as who's doing what to who and what are the rates and when do they take effect. So sure, I'll shoot you a copy after this and you can make it available. Yeah,
and we've got slides. We'll share those with the audience as well. We'll send out an email with that, and then as always, we'll post this to YouTube when Mike gets back. So probably early next week. I guess as we kind of wind down here, Nick, Jeff, any closing comments?
Jeff, you want to go ahead?
Closing comment. I think just stay calm. and stay tuned because there's a lot of moving parts here. And the initial take on any of this stuff is not necessarily the final or, where it will end up. So again, lots to take in, lots of information getting thrown at us, but it's not real until it's on paper. And that was something that people were saying yesterday, as far as even the commentators online, and they're saying, don't get too excited until you actually see what's in print and what's going to get enforced. So that's my only advice here.
Yeah, and I'll piggyback on that as well, which is, I mean, the bad news yesterday was it was much higher tariff and much higher protectionism than what was expected, but it does seem as though yesterday and today are quintessential peak tariff. That the rates should, aside from copper and platinum, which have an investigation going on right now, aside from those two markets, which are kind of nichey, on a broad basis, I think we are currently sitting in peak tariff zone, and there's room for negotiation for all these things to come down. And I personally still think they will come down. I think clear heads will prevail as we work our way through the woods.
Yeah, let's hope so. All right. Well, this was fun. I'm glad I got to do this, so I don't, get too rusty. Always good stuff. A lot going on. Stay tuned. We'll send out announcements as news breaks. We're here to help. I feel like a little bit of a reporter, Nick. We're reacting, hourly to stuff. So
you're even wearing the colors.
Yeah. So good stuff. Thanks to the audience, and stay in touch, and we'll try to keep you informed.
Excellent.
All right. Thanks, everybody.
Thanks, everyone.
Bye.